If you had invested just $10,000 in Nvidia 3 years ago, today you'd be sitting on well over $120,000. And if you had caught Palantir early and held through the noise, that same money could be worth close to $1 million right now. Those kinds of returns don't happen by accident. They happen when a company builds the right product for the fastest growing market in the world. But here's the problem. By the time everyone is talking about a stock, most of the upside is already gone. Nvidia and Palantir are household names now. The real opportunity is finding the next winners before Wall Street fully prices them in. So, in this video, I'm breaking down 3 smaller AI infrastructure stocks that are positioned to benefit from one of the biggest technology shifts of our lifetime. These are companies most investors are still sleeping on, operating deep inside the AI stack, and quietly signing multi-billion-dollar contracts with the biggest players in tech. We'll look at what they do, why their markets are exploding, the risks you need to understand, and finally, which one I believe has the best risk to reward right now. Let's get into it. All 3 companies we're talking about today operate in the same fast-growing corner of the AI economy. These are next-generation cloud providers built specifically for AI workloads. Instead of general-purpose servers designed for websites and databases, NeoClouds focus on dense GPU clusters, ultra-fast networking, and advanced cooling systems optimized for training and running massive AI models. NeoClouds exist because traditional cloud giants like Amazon Web Services, Microsoft Azure, and Google Cloud were never designed from the ground up for AI. They were built for CPUs, not GPUs. And as AI models get larger, more complex, and more expensive to run, that limitation is becoming painfully obvious. The customers using NeoClouds fall into 3 main categories. First are AI labs training foundational models that need enormous amounts of parallel compute. Second are enterprises deploying AI across their products and workflows, where low latency and high reliability are critical. And third are hyperscalers themselves, who increasingly rent external GPU capacity when demand exceeds their internal supply. This is why the NeoCloud market is growing at an insane pace. Over the next decade, it's expected to expand nearly 30 times and potentially reach $1 trillion in value. That implies growth rates far higher than the broader stock market, and even faster than traditional cloud computing. But this opportunity doesn't come without risk. All NeoCloud companies are extremely capital intensive. They spend billions upfront on land, power, GPUs, and data centers. That means they rely heavily on financing and are sensitive to interest rates and market sentiment. Their profitability depends on how efficiently they can keep GPUs fully utilized, control power costs, and convert capital spending into long-term contracts. They also face strategic risks. They compete directly and indirectly with hyperscalers who have near unlimited resources. They rely heavily on Nvidia for GPU, and they often have high customer concentration, with Microsoft and Meta representing large portions of future revenue. With that context in mind, let's talk about the 3 companies. First up is CoreWeave, ticker symbol CRWV. CoreWeave is currently the clear leader in the NeoCloud space. They operate over 40 AI-optimized data centers across North America and Europe, housing more than 250,000 Nvidia GPUs. They already have access to over 0.5 gigawatt of active power and nearly 3 gigawatts of contracted capacity, enough to support well over 1 million GPUs as new data centers come online. CoreWeave sells access to this infrastructure as bare metal GPUs or fully managed cloud instances. Customers can spin up massive clusters for training or inference without ever touching physical hardware. Financially, CoreWeave is growing at an eye-watering pace. Quarterly revenue recently surpassed $1.4 billion, up more than 130% year over year. But what really sets them apart is their backlog. CoreWeave now has over $55 billion in contracted future revenue, driven by massive multi-year deals with OpenAI, Microsoft, Meta, and Nvidia itself. That Nvidia relationship is critical. CoreWeave gets early access to Nvidia's newest chips, networking, and data center technology. Nvidia has also committed billions in direct investment and agreed to purchase unused capacity through 2032. In simple terms, Nvidia isn't just a supplier to CoreWeave. They're a partner, a backer, and a buyer of last resort. That dramatically reduces risk and strengthens CoreWeave's position as the launchpad for next-generation AI infrastructure. Next is Nvidia's ticker symbol NBIs. Nebius takes a very different approach. Instead of focusing purely on scale, they specialize in sovereign and regulated AI workloads. Think governments, banks, healthcare systems, and financial institutions that need cutting-edge AI while complying with strict data and security regulations. Nebius operates a full-stack AI cloud platform called Ether, which includes not just GPUs but also advanced governance, security controls, and compliance tooling. This makes them especially attractive to customers who can't simply use public hyperscaler infrastructure. While Nebius is smaller today, generating under $200 million in revenue, their growth is explosive. Revenue is growing more than 300%, and management is targeting a multi-billion-dollar run rate by the end of next year. Roughly half of that future revenue is already under contract. On the infrastructure side, Nebius is one of the most technically advanced Nvidia partners in Europe. They were among the first to deploy Blackwell systems at scale with next-generation InfiniBand networking. They currently have hundreds of megawatts of live power and are scaling toward multiple gigawatts of contracted capacity. Like CoreWeave, Nebius has secured massive long-term deals with Microsoft and Meta. The main constraint on their growth isn't demand, it's how fast they can build. What makes Nebius compelling is their focus on the hardest markets first. This is exactly how Palantir built its moat in software, and it gives Nebius a defensible niche as AI adoption spreads into regulated industries. Finally, we have Iron, ticker symbol IRN, formerly known as Iris Energy. Iron is the most unconventional of the three. They started as a Bitcoin miner and are rapidly transforming into an AI infrastructure provider. Iron owns massive renewable power data centers across North America with nearly 3 gigawatts of contracted power. Today, only a fraction of that power is used for AI, but that's changing fast. They've already deployed tens of thousands of Nvidia GPUs and recently signed a multi-billion-dollar AI infrastructure deal with Microsoft. What makes Iron unique is option. They can shift power between Bitcoin mining and AI, depending on market conditions. Bitcoin provides a baseline use case for their infrastructure, while AI offers significantly higher revenue per megawatt when demand is strong. Management expects AI revenue to ramp aggressively over the next 2 years, with the potential for several $billion in annual run rate revenue, and that would still use only a small portion of their total power capacity. As an investor, that flexibility is extremely valuable. Iron isn't all in on a single outcome. They have diversification built directly into their business model. So which of these stocks is the best buy? CoreWeave is the safest pure-play leader. They have scale, backlog, and Nvidia standing behind them. If you want the strongest risk-adjusted exposure to AI infrastructure, CoreWeave is hard to beat. Nebius offers the highest upside tied to regulated and sovereign AI. It comes with more execution risk, but also the potential to become a dominant player in a defensible niche. Iron offers flexibility and undervaluation. With massive power capacity already secured and growing AI revenue, they may be the most mispriced relative to their long-term potential. Personally, I'm comfortable owning all three because I believe NeoClouds will be as critical to AI as hyperscalers were to the internet. But if I had to choose just one based on valuation, optionality, and growth, Iron stands out to me today. And for new investors looking for stability, CoreWeave remains the strongest foundation. Let me know in the comments which one you're buying, or if you want a deep dive on any of these companies. Thanks for watching, and remember, the best investment you could make is in understanding where the world is going next.